Hello and welcome to today's webinar, Understanding the Fundamentals of Financial Statements and Accounting. This is the first of 3 workshops in a series called Taking the Fear Out of Nonprofit Finance and Risk Management, brought to you by the South Saskatchewan Community Foundation and the University of Regina's Community Engagement and Research Centre. We know that there are people joining us from a diverse range of organizations and communities from across Saskatchewan, and indeed we think from around the country. So if you have a moment, please take a minute to introduce yourself to the wider group in the chat with your name, where you live, and what organization you are with. Now, for those of you I haven't met yet, my name is Lynn Gidluck, and I have the privilege of leading the Community Engagement and Research Centre. Joining us today, I believe, is Karen Henders, who is Director of Community and Grant Stewardship for the South Saskatchewan Community Foundation. Most of the people that join us for sessions like these work for organizations that do not have a budget to offer professional development for their staff and volunteers. And my budget at the University of Regina is extremely limited. So we truly appreciate the support of the South Saskatchewan Community Foundation in sponsoring our toolkit workshops. But I want to tell everyone today that Karen Henders is more than just a funder. She has a deep passion for helping to improve our communities and is such a tremendous source of support in so many ways. She is a member of our Community Advisory Committee that helps us come up with ideas for the workshops we offer, and is definitely one of my go-to persons for support. Karen, on behalf of the Community Engagement and Research Center's Board of Directors and the communities we serve through our programming, please know how much we appreciate you. Now, I am pleased to introduce you to Dave Roszell. Dave is Executive Vice President of Finance and Administration at CAA Saskatchewan. He is a regular instructor for the Hill School of Business at the University of Regina, as well as Sask Polytechnic. However, Dave is not only an expert in accounting and all things financial, but he has a deep knowledge, understanding, and appreciation of the challenges that people working in the not-for-profit sector face. He has chaired a number of nonprofit boards, and because of his expertise, he is always one of those people that always gets asked to be a member or advisory to audit and finance committees. Dave, we are really grateful that you somehow found time to share some of your knowledge with us. Before we begin our session, though, David, I would like to quickly acknowledge that while today's event is taking place online and we have people from across Saskatchewan and across the country joining us, the South Saskatchewan Community Foundation and the Community Engagement and Research Centre have physical homes on the traditional territory of the Cree, Saulteaux, Dakota, Lakota First Nations, and the traditional homeland of the Métis. So we recognize Treaty 4, which was signed in this territory, and acknowledge the harms and the mistakes of the past as we, through our work with the university, try to do a better job working with communities. So with that, I'm going to just turn the floor over to Dave, and thanks again, Dave, for doing that.
Good afternoon, or good morning, I guess it is. I'm getting ahead of myself already. Good morning, everyone. And what I intend to do here is I got a few slides, quite a few slides actually. We'll just go through some of them. I will stop from time to time to ask if there's any questions or comments. I have the chat window open, so that's probably the best way, although I think you can probably unmute yourself and ask the question as well. I don't mind either way. We have approximately 90 minutes here. I will respect people's time and finish up in that time frame, and basically go from there. Now I'll start by sharing my screen here so that you can basically see the slide deck, and we'll carry on from there. Now, as you can see, I called this the seriously short version of this. Lynn and I were sort of chatting while people were coming into the waiting room. What we're probably talking about here is not 90 minutes, but it's probably 90 hours of class time. So this will be definitely the short version of this. And hopefully you can get a few ideas and things from this that you can take back. And, you know, what I'm looking to do, I guess, is plant some seeds And hopefully people can then go back and grow them into whatever plant they have to actually go from there. So what I want to start out with is talking a little bit about the use and users of accounting. Because basically in the accounting field, most people think, well, it's just the guys in the back room playing with numbers. Well, no, not really. We're in the information business. We're about communication. We're about communicating what the organization is doing financially. All right. And there's always two parts to every organization. It doesn't matter whether you're for profit or not for profit. There's the actual communication of everything, and then there's what you actually do. And in the not-for-profit sector, it tends to be different from the for-profit sector, because the for-profit sector, of course, basically the bottom line number called profit is what you're about. The not-for-profit tends to be a little bit more, what's the right word? Whatever. Anyway, caring, I think, might be a good word. That, you know, most not-for-profits have a specific purpose other than profit, and maybe multiple purposes. And a lot of them are everything from medical to you name it. And it's usually representing the interests of someone, okay? Not necessarily the people that are in the organization itself. Whereas the for-profit world, of course, it's all about the organization and the organization itself. Now, there are two broad categories of users. There's the internal users and the external users. And what that means, it's going to be ornery today, is it? Okay, we'll do it that way. Okay, the internal users are the people that are in the organization. I mean, it's fairly straightforward. It's not anything that's particularly difficult. These people are everybody from directors of finance to marketing people to production or program supervisors. It's anybody that's actually in the organization and needs to know what financial information is. Okay, the external users, of course, are people that do not work for the company, investors, lenders, those kinds of people, because even in not-for-profit, we borrow money. We have customers, maybe closely better maybe called clients, but I still consider them as customers. Employees, board members. Board members are kind of bridge the external users to the internal users, because sometimes they can be considered both. But nevertheless, they're there. And of course, then we have all of the taxing authorities and regulators if you are actually taxed. And where we go from there is typically the internal users need more and different information than they have, because they're actually running the organization. They actually have to figure out what's happening, what's going on. Am I even close to what I'm supposed to be doing? And in the not-for-profit world, we're driven more by budgets than we are for the bottom line. Now, it's not that the business community doesn't make budgets, they do. And they stick to them. Believe me, they stick to them. But they typically are not as budget driven as the not-for-profit or government sector is. Now, external users tend to want more summarized information, and they want it to be based on the same methodology each and every time they see it. So I'll talk a little bit about that in a couple of minutes, but both of them need information, but it is drawn from the same data set. Okay, and that's where we end up having to do things. Now, this is a bit of a series. We're going to talk budgeting in the next one. So I'm going to lay a little bit of foundation for that one today in terms of what we need to actually get the data set so we can actually give this information to various people and end up where we want them to be. So like I say, typically it's fairly straightforward. The internal people are running the organization. They tend to need more detail, and the external people tend to want it more summarized, and both groups have to be served by the same group of accounts that feed the statements. Now, one more thing before we open this up to any questions, okay, is there are two types of accounting out there, okay? One is called the cash basis, the other is called accrual accounting. Now, the cash basis of accounting is basically as transactions are recorded as they arrive. So if something arrives at your door in terms of money, that's when you record it in your accounting system. If you pay a bill, that's when you record it in your accounting system. And you don't make any effort to try and make the two match one another. So in other words, we get the government grant today and we spend it over the next 6 months. There's no effort to put revenue from that government grant over the statements over the next 6 months. We simply take the grant in as a dollar number and we then expend it as we go along. Now, there's nothing wrong with that. It's actually allowed, but it's really used for smaller organizations and often for internal statements because it doesn't matter. But the outside world, I'd have to say, geez, I'm getting old here. It's probably 25 to 30 years ago now. They started to force the not-for-profit sector to be closer to the business sector. And what happened there is that they introduced us to accrual accounting, which does adjust transactions to try and match the timing of revenues and expenses. So it introduces receivables, payables, prepaid items, and deferred revenue. Okay. Now, often as not, you often get a hybrid. What happens is that internally we work on the cash basis because that's what's important to us. We need to know what the money, where the money is, and whether we've got it or whether we haven't, and where we spent it. And on the outside world, when we're reporting to boards and we're reporting to the funders and government and anyone else, that we then tend to go to the more strict accounting type statements that are governed by the accounting rules that are out there. Now, the rules that I'm referring to are these. They're called generally accepted accounting principles. And it's just rules and practices. Rules, I hate to use the word rules because as often as not, it's guidelines more than rules, okay? The reason it's guidelines is because, of course, for every different organization that's out there, they have different things that are important to them. But there's basically 4 different types of accounting out there. The first one is the International Financial Reporting Standards, which most not-for-profits will never see or use. It's used by publicly traded corporations in Canada for the most parts. The next one is ASPE, which is Accounting Standards for Private Enterprises. That one you might see, but again, it's more for the profit sector than it is for the not-for-profit sector, because the not-for-profits follow the Canadian Accounting Standards for Not-for-Profit Organizations, which is very close to ASPE, but not identical. And then, of course, I didn't mention it on the slide, but government has its own group as well. And no one is required to follow any particular standards for internal use statements, but for external statements, you will be following one of these 3. Well, one of the 2, either ASPE or the not-for-profit. Now, before I go any further, like I said, I do have the chat window open, and you can unmute yourself. I believe we said it that way, Lynn, I'm not sure. But anyway, is there any questions on who uses these things and what the differences are between the internal piece and the external piece? Because the internal piece is pretty much the Wild West. You can do whatever you like. The external piece becomes a little bit more directed, shall we say. And usually your board of directors wants to see what's going on the external side. Just give it a minute here in case anybody's typing. Okay, we got a couple of questions here. First of all, what was mostly used in the US for nonprofits. This is Canadian standards that I'm talking about here. And the US has their own similar versions of this. And basically there's a not-for-profit section down there as well. It's very similar to the Canadian one, although there are differences. So I would encourage people, if they're operating out of the United States, that they check that specifically. We won't really have time to go into that today. Public sector boards will follow either the non-for-profit or the government regulations. And again, those two are not that different. Believe it or not, there's not a lot of difference between all four. Okay, they're all based on exactly the same thing. It's just some differences to allow for the fact that practices are different in the not-for-profit sector from the profit sector. Okay, now there's a question here that says income and expense separate for each grant if they have multiple grants. And I'll get more into that in a few minutes. The short answer is probably yes, but I will talk about that a little bit more a little later on. And there is differences between the financial statements. That's a question as well. I'm also going to go into that a little later on. Although again, there's not as much difference. There's more that joins the two together than there is separates them. Okay, we are going to have to move on here. So there's three types of organizational activities, and all organizations and companies are involved in this. And it's financing, investing, and operating. Okay, now here's what they are. Now, financing activities is obtaining and obtaining funds to finance the operations of it. Okay, so borrowing and repaying loans, that's not all it is. It's government grants. It's everything that happens to be there. Okay, I've kind of hesitated. I put debt. I'm concentrating on debt on this slide. Now, not-for-profits don't generally borrow a lot of money, although they can. Okay, it depends on how big you are and what you're doing and whether you need a building or whatever. It's not that you don't have mortgages and things like that. But in financing, I'm concentrating on debt here because what I do is I consider actually going out and getting grants to actually run the place, an operating activity, which is a little later on in this thing. So this is basically borrowing money and getting enough money to make sure the operations is going is the financing activities that an organization will go through. Now, investing activities is purchasing of long-lived assets needed to operate the organization. It's also some things like actual investments, like debt securities and things like that, that a lot of have people, and I'm using the word companies here sometimes. I should probably use organization more often than not. But some organizations, if we're fortunate enough, have some reserve funds, and we have to do something with them. And it's always a goal. It was always, I've been in not-for-profit and for-profit for 35 years now. Actually, yeah, pretty much 35 years now. In terms of not-for-profit and charity work. And I was in the for-profit business before that. And even as now, the CA Saskatchewan is a not-for-profit from the club point of view, but we have a for-profit arm that is a subsidiary. So I'm still involved in both. But what we're looking at here is reserve funds. If you have reserve funds, you don't want to let them sit in a bank account and make a whopping 1% right now. You want to try and do some things. So you have these investing activities, but it's a little broader than just that actual investment type of thing. It's actually any long-term asset. So if you own a building, CAA Saskatchewan owns half a dozen buildings, the not-for-profit part of the arm, and the for-profit part of the arm owns some too. But nevertheless, the not-for-profit does own a couple or three buildings. So it's any long-term assets. We own a bunch of vehicles. We have a whole bunch of tow trucks and things like that. So they go from there. Okay. Now, the operating activities, this is the day-to-day operations of the organization. So now you can see why I'm saying, you know, revenues or income, which is grants and things like that. That's different from the financing things. Okay. And it's a fine line, I get it, but really financing is about borrowing and that kind of thing, and operating is about getting grants or donations or selling things or however you do it. And it's about all of the revenues and expenses that you have for generally operating the organization. Okay, so is there anything about these particular three types of activities that we go through? Because this kind of governs what we're looking at in terms of financial statements. Now, there is a question up here already, banks loaning money to nonprofits without collateral. That's can be done, okay? That depends on the organization. I would suggest that what they're going to do is not necessarily look at, it depends what you want to borrow it for. So there's a bunch of different types of borrowing out there. Sometimes borrowing can be as simple as an operating line of credit on your bank account. That's considered borrowing in the accounting world. So what happens is, of course, if you've got overdraft protection on your bank account, that is a form of borrowing that your bank will do for you. Now, of course, anything more formal than that, if you need a loan to buy equipment and furniture, that kind of thing, well, then you already now got some collateral, okay? And of course, if it becomes a mortgage for a building, well, then you've got some collateral. And what they look at for the operating lines of credit and that kind of thing is things like your cash flow. So in other words, what is your normal flow of money coming in? And is it sufficient to make sure that I'm going to get repaid if I'm the banker? So I'm not sure if that answers the question, but it really, it depends on your relationship with your bank. But simple things like a line of credit, you don't really normally need too much collateral for. And then once you get into something more complex, well, if you're buying something, you have the collateral. Now, there's a question here on time frame when a charity can participate in investments. What governs that as much as anything is the charities division of CRA. You're only allowed to put so much into reserve funds, and then they want you to spend it. So that's kind of where it is. The not-for-profits, where there are not charities, are not governed nearly as tightly. So then you can do whatever your board of directors is going to be comfortable with it. Okay, so that's where we're at with that one. There are some restrictions under the government acts in Saskatchewan for sure, in terms of what you can do and what you can invest in. They have what's called a reasonable person test, and I hate those because what I consider reasonable and what somebody else considers reasonable is two different things. But there's not going to be likely any time limits on it. It's going to be the amount that's limited. Okay, and I think that's about it. You know, somebody came in and said, yeah, the bank looks at your projected cash flows for a loan. And that's pretty much it when you don't have a lot of assets beyond the office you're renting. Okay, let's move into financial statements then. There are four, okay? There's the income statement, which basically reports revenues and expenses for a specific period of time. And then you get a statement of changes in equity. You may see this called a statement of retained earnings. Depends on what organization you're with. in the not-for-profit sector, it can be equity and it can be just straight retained earnings. And both are still used, although I will tell you that the Canadian accounting standards are moving more to using the word equity. They also, you will see, member equity or things like that, where they use the word equity, but they basically preface it with something that is more specific to the actual organization. And it changes what equity is, and I'll talk about this again in a minute as well. What equity is basically what's left in the organization at the end of the year when all of the revenues have come in and all of the expenses have been paid, and you actually have a wee bit left over. Now, it's usually not a lot, but there's always something there because none of us like to go into the following year without having a little bit of reserve money. Even the smallest of organizations. And I mean, I've done everything from soccer teams to, baseball, you name it. And even at that, we always wanted to have a few bucks in the bank account to start the following year. Now, then you get the statement of financial position, which most people will probably know as the balance sheet. And it's still called that to a large degree, but the actual name of it now is the statement of financial position. They've brought that in from IFRS into Canadian standards. The final one is the statement of cash flows, and it looks at actual how you obtained cash and how you used it for a period of time. Now, these are the way you prepare these things. You prepare the income statement first. It flows into the statement of changes of equity, which is a section of the statement of financial position, which is from the statement of financial position, you can make your statement of cash flows. Now, I don't want to get too deep into the weeds here. What we're basically going to look at today is this one, the income statement, in a fair level of detail. I'll talk a little bit about this one here, the statement of financial position, and I'll talk a little bit about the statement of cash flows. But if your accountant, if you are trying to supervise your accountant, they're going to work on this one first, which then flows into the statement of changes of equity, which flows into that one, and that one is derived from the statement of financial position. Now, what frequency do we do them? The income statement is the most frequent. Okay, and typically they'll produce something monthly. Depends on how often you need this information and how big the organization is and how often you need to report things. And often as not, it's going to be governed by the board of directors, okay? And, the board typically, some boards meet monthly. Typically boards meet quarterly. They don't meet every month, and depends again on the organization and the size. And that's going to govern the frequency of a lot of your statements. But the income statement is going to be the most frequent because you use that one to run your organization. Okay, it has the revenues and the expenses. And of course, at the end of the day, you need your revenues to be at least equal to your expenses and hopefully even a little bit more. You can deficit for a year or two usually, but it's not a good plan to do that forever. And so that's why the income statement is much more frequent. Now, the internal ones, as I have said earlier, don't necessarily have to follow the generally accepted accounting principles, but they're done much more frequently. The actual statement of financial position, which talks about the assets and the liabilities of the organization, in other words, things we own and things we owe, is done mostly in conjunction with the frequency of board meetings. If your board meets quarterly, you will do your balance sheet on a quarterly basis, likely. It's going to be done at least annually so that you can, particularly if you're subject to audit, which most organizations are, at least an audit review, if not a full-blown audit. Now, the cash flow statement and the statement of equity are usually only done annually because they're not used a great deal internally. I want to reserve that comment a little bit because some people do use your cash flow statements fairly significantly, but not all. But all four statements are going to be done at least once a year in the form of the external rules. And then internally, you can do whatever you want, but often you end up with an income statement at least, and maybe some or all of the statement of financial position. Now, is there any questions on what the four statements are before we go into more detail on a couple or three that I intend to do? Okay, now in terms of preparation, like I said, you start with the income statement and you work your way through. But I'm going to leave that one till last, all right? Because that's the one that most people end up needing to use mostly. Okay. There's a question on the cash flow statement. Prepare a check for cash before making payments on the payable. No, not really. The cash flow statement is designed around showing you where you got your money from and where your money was spent. Okay, it's an after the fact statement. What you really have to look at there is probably more the internal records of the organization in terms of bank statements and the statement of financial position. Okay. So here we go. Here's the statement of financial position. I've got a couple of different examples here. This is the simplest form of it. As you can see, it basically just lists all of the assets here. All right. Now, the definition of an asset is something that will benefit the organization in the future, okay, because it is at a point in time. The financial position is often called a snapshot of the organization at a point in time. So this is fictitious. It's just numbers pulled out of my head. They don't even all match together, okay? But typically you're going to see the current month in there. You might see something like the previous month. You might see what happened last year, okay? Or you might just see the current month. But this is just a list of all of the things that the organization owns, okay? Or has a right to receive, okay? So cash is your bank account. You might have a money market account out there. You might have some temporary investments in something like T-bills from the government because, as I said earlier, in your bank account, you're making a whopping 1/4% if you make anything at all. And so you don't want to leave money that's going to be sitting around, you know, particularly if you get a large payment that you're going to expend over a 6-month or 8-month period. You can actually put some of it away in a T-bill from the government and make a little bit of interest on it for that 6-month period because you don't need the money right now. You're going to need it in bits and pieces as you go along. So you can put a little bit of it away in something and pull it back in and have made a little bit of money on it 3 months from now or 4 months from now, which is what this money market account stuff is all about. Now, like I said, I've just plugged numbers in here. Some organizations have accounts receivable, some people don't. Some people might have an interest receivable, some people don't. GST or HST receivable. Of course, this is the input tax credits. Some people have inventory, some people don't. Prepaid expenses are things like insurance, where we buy it now and it lasts for 12 months, okay? So if we're looking at this at a point in time, we actually have insurance that we've bought that we haven't used yet, okay? We might have bonds or other investments. This is just a bit of a laundry list. No one company likely has every one of these, okay? Furniture and fixtures, vehicles, buildings, okay? These are all things that the organization has either owns or has a right to receive or use, okay? The next side, of course, is the liabilities and equity side. And of course, this is things that we owe people, okay? If we actually collect any PST or PST or HST, okay? We might have something else where we owe people. Deferred revenue I've put in here. If we have time, I'll talk a little bit about that nearer the end. What this is where, if I don't know very many organizations that do, but there is out there a deferred revenue methodology for using donations that are going to be used in the future. It's not going to be within the scope of this session to try and describe what that is, but it is out there. But basically what this is, in the for-profit world, this is things like deposits. So if somebody sends me a deposit and I haven't delivered the goods or services yet, I throw it in here because there's a possibility I may have to pay it back if I can't or won't deliver the goods or services. So it goes into this deferred revenue thing. And then it's sitting there as me owing it to somebody and not me having it available to spend. Okay. Then you get down to some of the longer term stuff, which might be a mortgage. And then you get your retained earnings, and some organizations use the year-to-date income or loss all in the one piece. Now that's one way to do this. Okay. The second way is we start to classify these things. Okay. Now here's the various classifications. I don't again want to spend a lot of time. Well, I'll go into a little more detail in a minute. I'll show you what it looks like first, and then we'll talk more what they are. But we're talking about current assets, non-current, current liabilities, non-current, and then the equity. Okay. Now this says shareholders' equity because I borrowed this slide from a textbook, and it was for profit. But this would be whatever equity section the company has. Okay. Now what that changes us to is something that looks like this. Okay. So it's exactly the same sheet that I had before, but as you can see, we've broken it up into all of the other things that are there. So we've got all of the assets still, but what we've done is we've said, okay, these are cash. Okay. We got a question here. I'll deal with it in just a sec. Okay. We've got all of the things that are more here. And then we got the bond investments, and then we've got all of the longer term stuff, the fixed assets. Okay. Now the question is, what does plant mean? Okay. Often as not, you'll see this down here as referred to as property, plant, and equipment. Okay. And your plant is, if you're in the manufacturing section, it makes more sense to have, you have a manufacturing plant. Okay, but it's a broad general accounting term that's used to basically talk about buildings in the organization. Okay, now legacy gifts from wills and things like that are deferred payments. Depends on how your board of directors is using these things. But short answer is probably yes. Okay, because you're not likely going to use it right away. Okay, now what happens there, pardon me, what happens there often is you end up putting it into an investment someplace. So it ends up showing up in here. Okay, we get the will, we show it as revenue, and we put it into an investment someplace until we're actually going to use it. So we put it into the investment section. Okay, and somebody's having access to the slide after the seminar. Lynn and I talked about that. Yes, I'm going to send her these slides after we're finished. So, and I believe she's recording this as well, so you have both. Okay. Now, land donated to the city, a value of land considered deferred revenue. No, not really. What you have to do with that is you have to set it up. You have to get a valuation for it of some sort of, get some sort of what the land is actually worth. So it ends up as being an asset because you now own it because it was donated, and you end up with a donation in kind on your income statement. Okay, the same number. All right, if you end up with the land valued at say $50,000, just picking a number out of the air, you would end up with land on your statement of financial position of $50,000, and you would end up with a donation equal to that. Okay, Now, again, I'm going to, capital asset values net of depreciation, yes. Okay, now I'll talk a little bit more about that again if we have time near the end. It was about 25 years ago that the depreciation was started to creep into the not-for-profit sector. Prior to that, I was working for CNIB at the time. And prior to that, we never bothered to depreciate a whole lot because basically what we did was is if we needed a car, we went out and fundraised for it and we bought a car. And we never ever, none of the program funders for grants or anything else would recognize depreciation as an expense. So we didn't worry about it. But it was about that time, about 25 years ago, that the accounting, the problem with that was is it could be manipulated. And the accounting people, was the CICA, the chartered accountants at the time, were fearful of that, and they were getting reluctant to put their name to audited financial statements that didn't have depreciation in them. So they basically have moved depreciation into the not-for-profit sector, and most of the larger not-for-profits now, medium to large not-for-profits, recognize depreciation. So you have to be very small to not do it anymore. Now on the liability side, again, we've got current, we've got the long-term, and we've got the equity section down here. So we tend to classify the thing. Okay, and that's what it's called. It's actually classification. Now, what do the classifications mean? Okay, current assets are things that are going to be converted to cash, sold, or used in the organization with one operating cycle, which is the accounting definition, which in English means usually 1 year. Okay, so if you look back at this thing, went too far. Okay, cash, money market accounts, these are things that are going to be around. They're current because we're going to be using them within a year. We're hopefully, if we have receivables, we're collecting them before a year is up. Okay. Any interest, we're hopefully our GST and HST will get from government within a year. If we're actually selling anything, hopefully we're not keeping it around for 5 or 6 years. So you can see all of this stuff up here is going to be used in the organization within a year. Okay. Now they're ordered, now just again, this is a bit of an accounting slide. They're usually ordered in order of liquidity. In other words, how fast am I going to be able to get cash? Well, cash then is always the first one because it is. Receivables, I should be able to collect within 30 days or so. Government might be quarterly. Inventories, depends how fast I sell it. Okay, so it depends on how quickly I'm going to get cash for all of these things or use them. Okay. And again, all of the various things that I've been showing you. The longer term stuff is a multi-year investment. Now, it can be an investment in loans to other companies. It can be other notes, bonds, mortgages, but we're talking about the investment side. So this is where we're loaning somebody some money. And effectively, if we buy a bond or if we buy a mutual fund, we're loaning somebody some money. Okay. And they're not intended to be sold or converted to cash within 1 year. So in other words, they're kicking around for a while. And then property, plant, and equipment, as I said, this is the accounting term. Really, plant means buildings, that kind of thing. Okay. Now these are usually ordered and listed in order of permanency. Okay, so usually land is first, although I know on mine I had it last. But nevertheless, okay, you can see in this list, I've got it more in order of permanency. Maybe a toss up between computers and vehicles as to how long they land. I guess it depends on how much you drive the vehicle. But land is going to be there forever. The buildings and equipment tend to be longer. Hopefully the thing's not going to fall down in 2 years. Furniture, 5 years, maybe. Computers, 3 to 5. Vehicles, again, 3 to 5. Okay. Current liabilities are again obligations that are paid or settled within one operating cycle, which, like I said, in English is 1 year. It's bank indebtedness. Now, bank indebtedness is your operating line of credit. So if you overdraw your bank account, it's actually technically a liability. You owe the money to the bank. Accounts payable, we owe for our utility bills or whatever else. Unearned revenue, again, that should be deferred revenue. Both terms are used synonymously, unearned and deferred. And this is where we park things where we've got the money, but we do not want it on our income statement yet because we might have to pay it back. And you get bank loans that are short-term, less than a year, and things like that. Now, non-current, of course, is going to be your longer-term loans. All right. And finally, we get the equity section, which is usually only retained earnings in a not-for-profit, but that's the cumulative income kept for use in the organization. And what often is not happens in not-for-profits, not often is not, but sometimes happens, is we get restricted retained earnings. So in other words, we get the income this year and we haven't spent it all. So we get the grant, and we get the grant in November. And it's supposed to be a 6-month project. Well, there's no way by the end of the year that we can say that we own that money yet, because we haven't delivered the services that the grant was for. So we either put that in 2 places. We either pull it all into revenue and we put it into restricted retained earnings, or we put it into deferred revenue and carry it over to the following year. So again, I don't want to get too detailed on that, but you need to do something with it, because you can't basically say that I've got the whole grant this year and have a big profit, and then next year have a big deficit when you start spending the money that you actually got the year before. So that's what happens with the accounting of those sorts of things. We end up dealing with it on the end of the year, and more commonly it goes into deferred revenue. And then we pull it back into the income statement when we actually use it. Now, another form of restricted earnings is things like wills and donations and things like that, where we've taken the money in, we've gotten the investment, we've gotten the money from the estate, but we have to spend it on a particular program. Okay, so we invest the money. So as I said before, it ends up sitting here in a bond investment, okay? But we can't put it into the income statement yet. So we end up putting it over here in retained earnings, but we have to spend it on something. So you get this restricted retained earnings. And all it means is that there's something in behind. And you're going to see this in what you would see is the audited statements would see this. They'll put a note in the statement that basically says what the restriction is. And basically what we're talking about usually is the restriction is put on there because it has to be spent on a particular project or a particular thing. Now that's kind of the Coles Notes version of the statement of financial position. Normally you're going to see it classified. You're not going to see it in this very simple format very often, okay? Smaller organizations, yes, because they won't even have most of this stuff, okay? They'll only have 3 or 4 of these things. They'll have cash. They might have a bit of inventory of something. They might have a short-term investment because they've got some cash, okay? They don't own any vehicles. They might own a bit of equipment, okay? And that's about all that goes there. Okay, so normally you're going to see this classification system that I've put up here, which makes it look like this. Okay, and then current versus long-term is basically used or owed in 1 year or less, or used or owed 1 year or more. And if your asset side is greater than your liability side, you will have some leftover money for equity. Now, there's a question here on the reserve funds. The equity statement is basically a expansion of this number right here, or these 2 numbers right here, okay? So your chances are pretty good that yes, that's exactly where you'll see it. You might see a line in here that says reserve funds as well. There's some latitude to make sure, I'm using the term retained earnings because that's the most common one that's out there. But as soon as you get into restricting things or reserving things, you end up with more lines in here. And then the detail does go, okay, to reserve funds. And then somebody's asking, can they have reserve funds? Again, as I said earlier, yes, you can, but it's going to be limited by A, your board of directors, and B, the Canada Revenue Agency in terms of what you can have and what you can use it for. And most not-for-profits, I know we don't do it here at CAA because we're operating it actually more like a business than a not-for-profit, but I know when I was working for Canadian National Institute for the Blind, we wanted to have reserve funds so that we could operate for about 3 months if no funds at all came in. Now that of course never happened, but that was the goal of the board of directors. So I usually had to have 3 months of operating income in reserve funds. And then the CRA restricted how much you could have above and beyond that. Okay. All righty, statement of cash flows. All right. It reports on the 3 activities and shows a net increase and decrease in cash for the period. So that's why it can't really be depended on in terms of knowing how much cash you actually have. Okay, you're better off to look at your statement of financial position and your bank statement to determine that. Okay, but it looks at this and says, okay, you had a net income from operations. We do some adjustments to it. Okay, and we end up saying that our operating activities provided this much cash. Now, this one's out of a for-profit corporation. That's why it says XYZ Corporation on it. I did this deliberately, whereas everything else I'm showing it as an organization. Okay, but this is the same statement as you would see, and this note that we're talking about would have all the differences in your current assets and current liabilities. So this basically says that this is where we got, our operating activities provided this much cash that year. It carries on and says, all right, in investing, we used it to buy whatever, okay? Or we paid back a loan and everything else. And it says we have a net increase or decrease in cash, and we have the cash at the beginning of the year, cash at the end of the year. And basically what it does is tells me the difference between last year's cash number and this year's cash number. That's basically what it does. So as you can see, on an operating basis, it doesn't really do a whole lot. But people like your bankers, if you're, again, we go back to the question of a not-for-profit being able to get a loan without a lot of collateral. If this cash flow shows that you're making money from operations and not spending it all on something else, then your banker will probably do it, because then he's saying that you can generate money from operations up here to pay me back down here. Now, I don't want to spend a whole bunch of time on this animal, but if there's any quick questions. Okay, income statement then. There's, it's basically your revenues and expenses, and of course your net income or loss is your revenue minus your expenses. Okay, even obtuse accountants like me can figure this one out. But there's of course 2 formats, okay? And I call it the program-based format and a functional line item format. And it depends on the audience and their intended use. One will be favored over the other. And the order here, when we're doing accounts in this, is monetary size or alphabetical. Okay, so when I start showing you the examples, the order in which you put the revenues in or the order in which you put the expenses in is either by monetary size or alphabetical. Now I'm going to show you basically 3 examples of an income statement to explain what I'm talking about when I'm talking about program-based and functional-based. And I'll talk a little bit about that, each one as we go along here, so that you know what they're used for and how they're used. So the first one is this program-based example. So what you see here is, the revenue lines at the top: donations, government grants, other revenue. Normally you're going to have the current year. You're likely going to have a variant budget. Internally, for sure, you're probably going to want a variance report. Likely you're going to want that for your board of directors as well. So what you're seeing here is the donations were $788 higher than our budget. our other revenue was 751 lower. So on the whole, we pretty much made our budget. When we get down to here, we can see our salaries were slightly lower. Somebody quit partway through or that program cost us slightly less. Sorry, got ahead of myself. Okay, and this program cost us slightly more than what we budgeted. This program cost us slightly more. Some of the other things down here, we ended up with $1,958 to the good, simply because program one didn't spend as much as it should have. And at the end of the day, we had this much revenue, this much expense. We ended up with a small amount of income at the end of the year. Our budget, of course, was zero, and our variance equals our net income. Now, this is what I call the program base, because what we're basically saying is this is what it cost me to do that program. This is what it cost me to do a different program. This is what it cost me to do a third different program. Now, as you can see, the star, this is not particularly useful statement for actually running the organization, but it's a great statement for giving to boards of directors and funders and things like that, because funders say, okay, I'm giving you money for this program. How much did you spend on that program? Okay, I've given you money for that. How much did you spend on that particular item? Okay, but to run the company, you need it to look more like this. Okay, this is a program schedule. Now, you might not put the revenue in. Okay, you might or you might not. Okay, but it depends. Again, if you actually get a specific government grant for a particular program, you can put the revenue in. Again, you're going to have a budget. Again, you're going to have a variance. But now you see, we get down to, we want to know the actual individual pieces here. Okay, here we go. All right, salaries and benefits, program, travel, miscellaneous. Now, this can be anything and everything. Okay, it depends on what the program is. The things you're going to see probably all the time are salaries and benefits and miscellaneous. If there's travel involved, yes, you're going to see that. Those are kind of the three that are always going to be there. The program supplies I've used as a generic term there, okay, because of course it's going to depend on the program what you're actually using. Now, somebody has said there, do you recommend reading the notes first so that you understand where the variances originated? Okay, if you're doing this type of statement and you're providing this type of schedule to your board of directors, then they're going to want to have an explanation of why these numbers are what they are. Now, what you want to do is make sure they're not going to detail you to death, because there's always going to be that one guy that wants to know where every penny went. Okay, but what you really want to do is get them at the summary level like this. Okay, and okay, why were we $4,000 under on this? Then they can go to this schedule and say, oh yeah, our salaries and benefits weren't that big. Now, of course, these don't match, they weren't meant to, okay? But that's the kind of thing you would do. So when you're reading this, all right, I wouldn't necessarily go to the notes first, but I would look for numbers of a specific size, okay? Is it plus or minus 5% of what the budget is? Something like that. And then go down and look at this and say, okay, that was the reason. And there probably will be a verbal piece that goes with this program schedule that explains what's going on out here. Now, that's the first type of statement that I like to show people. Okay, it's program based, okay, because it's showing you what it cost for a particular program. But invariably, you end up having to have something that's got a little more detail in it, so that you can actually keep track of what's going on. Okay. Any other questions on that thing? Now, the other one is what I call the line item example, and it's basically, it looks a lot like the program schedule because it basically is. Okay. Now, note here what I did. All right, I've got the three programs here, and then I've got kind of things that don't make any sense to try and charge to the programs. So this would be general items over here, down here at the bottom, that don't belong to any one program specifically. And I can see I can spell well. Oh, well. I'm an accountant, not an English major. This one, as you can see, looks a lot like the schedule, but the actual income statement is here. Now, this tends to be more what you see in business, but it can also be what you see for single purpose organizations. Let's put it that way. So in other words, if I have one single purpose in life as my organization, and we do X, then, okay, I don't really need to break it down into the various programs because I only have one, okay? So I basically then just put my revenues at the top and all my salaries and expenses at the bottom, okay? Now, again, this one doesn't require any supporting schedules because it is the supporting schedule, but you would probably have to go through and do a narrative after the fact explaining any variances out here over a certain size. Now, that's something I would encourage you to go to your board. I don't care about $1, okay? I don't care about $6, all right? But in a $135,000 budget, I might want to know why these two were the way they were, okay? So let's see what, you want to keep them within a certain range. The other thing you can also do is that, I may have underspent a little bit on this one and overspent a little on this one, but at the bottom line works because the person that gets the budget absolutely perfect is the person that knew what was going on before we go there. Okay. Now, depreciation shows up on the income statement because that's what it is. Okay. Depreciation is an expense. Okay. And the opposite side of it is net to the assets that we were talking about earlier. And I didn't quite want to get quite that deep, but I will make some time at the end to talk about depreciation more. Okay. And depreciation is an expense. Now, what you're trying to do, just to preface a little bit about what I'm going to talk about later, is what you're trying to do is you bought a building, so you're going to use that building over the next 10, 15, 20 years, okay, to deliver your program. So what you're trying to do is attach some of the expense of buying that building to the annual use of that building every year. Okay, and that's what depreciation expense is. Third type thing I'd like to show you on the income statement here is a hybrid. Okay, now this one's often used where you have a considerable amount of volunteer labor delivering the program. Okay, and things like churches come to mind, where you have a pastor and a secretary and maybe a couple of pastors and a secretary as the staff, and they're involved in all the programs, but it doesn't make any sense to divide their salaries to each program because you start doing something arbitrary, like saying the pastor's supposed to spend 2 hours a week on this program and 4 hours a week on that one. Well, what if he doesn't? Because he has a funeral that week. Okay. So it becomes an arbitrary thing. So there's certain expenses up here that you just keep the line items to, but down here, we want the actual cost of the program above and beyond the labor involved to deliver it. So this would basically be program supplies or travel expenses for that specific program, that kind of thing. Okay. And then down here, again, we get the kind of overhead type of stuff that doesn't make any sense to try and subdivide between the programs. Okay. So that's kind of the income statement in a nutshell. All right. And are there any further questions on that? Now, again, for running the company, you're going to need this kind of detailed information. But for other organizations, it may well be summarized something like this. Now, when I'm talking about statements, I'm talking about the end game here, because that's what the accounting system is designed to produce when we're all said and done. And there's a couple of branches of accounting. One is management accounting and the other is financial accounting. What we're talking about here mostly is financial accounting. Management accounting will then take that statement and analyze the heck out of it and try and figure out what's going on. And probably you, as various people involved, will actually flip into that side of it more. And that's part of the reason I put the variance piece up there. The financial accounting people will calculate the variance. They won't try and interpret it. It will be up to the person after the fact to say, okay, this is why it was higher or lower than what it was supposed to be. And what you present to your board is likely from the management accounting side. So you present a summary of all of the income statement and then describe what has actually happened in terms of variances. But to build this thing, okay, you actually have to have accounts in behind. So if we go back here, let's just go all the way back to the this thing, okay? Each line in here, cash, money markets, accounts receivable, all these lines where we've actually got a number beside it, all of these lines will have an account in the accounting system, okay? So that's the statement of financial position. Cash flows will not have accounts in the system. Okay, the income statement will. So anything that we have here will have an account in the system. Now, the reason I'm going back here is because you don't likely have an account called Program 1. What you've got is 4 or 5 accounts that are funneled back to Program 1. Okay, so what the accounts have to be is at the level of detail that you need, that you can always summarize back to a single line on a statement. Okay, but you cannot give yourself the detail like this if you don't have an account in the system, and you try and do it by just dumping everything into one account called the Program 1 account. Okay, so if you want information like this that breaks it down, you're going to have to actually have 4 accounts in this system to get what this $55,000 was all about. Okay, so this is a summary number. It's actually adding the 4 things in behind. Okay, back here. Okay, so the building blocks that we start to build these statements, we start from this account. Okay, and it's collected together into this thing called the chart of accounts. And the reason I'm going here is of course, like I say, the next session we're doing here is a little bit on budgets, and we will do the budget at the account level. Now, here's how I like to describe this a little bit. All right, you'll have heard of the term in accounting of a journal, and you'll have heard of the term in accounting of a ledger, or you may have. It's 2 different things. A journal is a list. And what we do in the accounting systems, now of course it's all computerized now, is we journal things. So what happens is we make a list of all of the things, all of the transactions that happened in a particular day in a journal. Then once the day is over, we take the journal and we go to the ledger, and we start doing a practice called posting, which takes that list of transactions and puts them into the ledger. Now visualize the ledger as a big box of cards that has 1 card in it for every account that you have. Okay, so every account that we want to actually have transactions go into, the accounts are going to accumulate the transactions. So every little card in the system is going to accumulate transactions. Okay, and the chart of accounts is basically just a list of all of the cards that you have in your box. All right, now I've talked about this a little bit already. Okay, we need the accounts at the level of detail. So if you want to do a program-based statement, it's actually going to be at the level of the schedule, not the program-based statement. Okay, so whatever level of detail you need is going to be the level of number of accounts that you're going to actually need. So is there any questions on what an actual account is and how many you actually need? So you may, I guess before I go there, there's one more thing. If you're doing program-based statements, you may have half a dozen salary accounts. Okay, you may have salaries dash program 1, salaries dash program 2, salaries dash program 3. Okay, now that allows you to summarize it by program. So I can go on and pick up the salaries, the travel, and the miscellaneous expenses and program expenses all for the program. Or I can go the other way and add the 4 salaries or 3 or 4 salaries accounts together and know what salaries I have in total. But if I don't have that level of detail in my chart of accounts, I'm going to miss one way or the other. Okay, so if I only have one salaries line, I can't get the program information. If I only have the one program information, I can't get the detail information for the salaries. Okay, so that's why you have to go to the greatest level of detail in your chart of accounts. Now, are there any questions on that one? Now, transactions, okay, of course, we've got the processing transactions. Most of this is done computerized now, unless you're very small and doing it on a spreadsheet. Okay, the types of transactions are very widely, the type of business, the type of size of it, the amount, the information requirements, okay, all of those sorts of things get in here. But what you've got to remember here is a transaction is an economic event that has to be recorded in the financial statements. So what you have here is events that need to be recorded financially, not something that is just an event that happens in the organization. Now, if you were a bunch of accounting students, what I would do is I would throw up a slide here that has, somebody buying something and somebody talking on the phone to a supplier, and then somebody taking in some money. And only 2 out of those 3 are going to be accounting transactions. The guy talking on the phone to the supplier to find out how much something's going to cost is not an accounting transaction. It may turn into one because once he finds out what it's cost and he's got the money and he buys it, now you've got an accounting transaction. But you have to have an economic event before we actually record it. Now, what we're looking at in here is something called the accounting equation. And I want to just spend a little bit of time on this because, as you can see, this assets equals liability plus equity thing is how this expands into your actual statement. So I've got a whole bunch of accounts that are assets. I'm going to add up all the transactions there. That has to equal all of the transactions in my liability section and my equity section combined. And if we expand it, okay, the assets are the things we own. The liabilities are the things we owe. You can see 2 pieces of the statement of financial position right now. And now you can see this equity section of the statement of financial position has buried in it the retained earnings, which is what's been earned up to a particular point in time. Plus it has the income statement added in. So when I was way back here, where are we? Keep going. Smart man would have remembered what slide, 19. You can see I've got the retained earnings plus the year-to-date income or loss. So this is the net income. This is the income statement flowing into the statement of financial position. And it's all about this accounting equation. And of course, what we get is debit and credit. Now, I don't want to make accountants out of people, but you will hear accountants will talk about debiting this and crediting that and horsing around. The account has a debit balance, account has a credit balance, all that kind of thing. And everybody sits there and says, well, what does all that mean? Well, okay, basically it has to do with the left-hand side and the right-hand side of this equation, okay? This is the basic equation of accounting, all right? And if you're doing something on the left-hand side, it's done with debits and credits one way. And if you're doing something on the right-hand side of this equation, it's done with debits and credits another way. Now, we could have called this Sally and Jake, okay? There's probably something out there that what debit and credit actually means, but it's beyond me and I don't feel like looking up the old Latin. But basically what we're talking about is entering transactions, because all transactions have to have one debit and one credit at least, okay? So they may cross over various statements, but if we're debiting something, it's going to be to increase an asset or an expense and decrease a liability, retained earnings, or revenue. And if we're crediting something, it's the opposite way around. It will increase a liability, retained earnings, or revenue, and decrease an asset or an expense. And if there's an account in the system, if the transactions exceed, if debit amounts in the transactions on my little card that are, I took my journal, I recorded everything on my little cards. If the amount of debit transactions actually outweigh the credit transactions, then that account is considered to have a debit balance, and of course the opposite way around. Now, that is the real thumbnail sketch of what debit and credit's all about, but I will pause this for just a second if anybody has any questions on how we start to build this. And like I said, the reason I've thrown this in here today is because, of course, we're talking about statements. That's the end game. When we actually want to build that statement, we need to have some place to start, which is all of these accounts. And then when we go to do budgeting in the next session that we're going to do, we do have to start at this account by account level. Okay, we're getting pretty close to the end here, but anyway, all right, now depreciation, I did put this in here because I know that a lot of not-for-profits don't do a lot of depreciation, okay? Now, this is a couple of slides directly out of an accounting textbook, so it basically is not the best, but it works for me, okay? So first of all, what we're trying to do is allocate the expense of the cost of property and equipment over their estimated useful life. So if I buy a building and I figure it's going to last me for 25 years, then I want to say that I spent $500,000 on that building, okay? Then I want to, over that 25-year period, put something on my income statement that says I've used part of the value of that building. Okay, so what really happens here, all right, is you get depreciation expense saying I've used part of the value of the building, and up here, okay, up here, it decreases the value of these things, okay? Now, a lot of not-for-profits don't do depreciation on their internal statements. I know I've been on church boards forever, and some other boards as well. And we don't bother with the depreciation until the end of the year, okay? And there's arguments both ways on that, because of course your depreciation, actually, if you covered off your depreciation in your income statement, then you've got some cash, extra cash to do something in terms of improving your buildings. But nevertheless, that aside, all right, when we actually do the audited statement that goes out, the auditor comes along and does the depreciation. So what he does is he does an entry that will decrease the value of these on the statement of financial position and place an expense on the income statement. And what he's basically trying to do, okay, is say that you used that building for a year, so now it's not quite worth exactly what you paid for it anymore. Now, this is an accounting transaction. Okay, it has nothing to do with real estate, because I'm sitting in a building here with CA Saskatchewan, a good chunk of which was built in 1961. Okay, so what we paid for it back then has nothing to do with what it's worth right now. And actually what we've got it on the books for has nothing to do with what it's worth right now. We could probably get a few $1 million for this piece of property. We're not going to, because it's paid for. Okay, but what it's on my books for is substantially less than that. Now, you may hear this called amortization as well, all right? Depreciation is usually used around the term for assets, fixed assets, and amortization is used if you're doing something for intangibles, okay? So depreciation is probably going to be the term you see more often. And the two accounts that end up involved in this is accumulated depreciation And it's a net value against the assets. So when we're doing the accounts, we're going to have a building account that has in it what we paid for it. And we're going to have this accumulated depreciation account, which is how much we've put onto the income statement every year for having used it to some degree. And the net of the two devalues the building a little bit and puts the amount of depreciation onto the income statement. Now, again, that's a concept that is somewhat, well, I hate to use the word foreign to not-for-profits. It's just basically not that important to them, because a lot of times, as I said, but I worked for CNIB, okay, if we needed something, well, then we had to fundraise for it, okay? So the concept of depreciation really didn't mean a whole lot to us in terms of actually running the business. But you will see it, and it will be there, and it will be there on anything you need to do for an external statement to a bank or to a funder or to a government, or the audited statement that the board needs every year will have depreciation in it. And effectively what you're doing is moving a little bit of money off your statement of financial position that represents the fact that you use that asset for that period of time and making it into an expense. Now that's about all I have. Got a few minutes left here. If there are any further questions. And as I said, I will send these slides to Lynn and she will have them available for anybody. So kind of last couple of few minutes here, we got about 5 minutes left. If there are any specific questions I can try to answer, I will try to answer. I don't know, Lynn, we're not lighting up the chat board here.
Well, Dave, I think this is more a reflection of the statement that you made earlier in the session when you opened up about how that you managed to somehow do the Reader's Digest condensed version, Cole Notes, in 90 minutes, what you sometimes have done in 90 hours. So there's a real art to that. And so I would like to thank you, but I noticed there's one person who's wants to ask a verbal question. So why don't we let her go ahead?
Yeah, go ahead, Nora.
Hi, Dave. Thanks so much. My question is around depreciation, and I know you didn't want to get too far into this, but I did ask that one question about why depreciation was on the income statement. So in our organization, we show depreciation on the cash flow statement and also then on our assets and liabilities. So is it incorrect not to show it on our income statement?
It should be on your income statement. It will also appear on your cash flow statement because your cash flow depreciation is what's called a non-cash expense. And the reason is because you expend the cash when you buy the building to begin with, right?
Mm-hmm.
Okay. So then we're only doing an accounting entry that moves some money off the statement of financial position into the income statement. So when you're doing your statement of cash flows, okay, you don't want it in there. So that's why it appears on the statement of cash flows, because you're actually adding it back. You're reversing the transaction that you did, put it on the income statement, okay? And it's called accumulated depreciation on the statement of financial position because of course that's the credit side of the transaction and the debit side is on the income statement. So it actually appears in all three places, or should. Now they may be burying it somewhere on the income statement side. I won't say that there's a separate line for it, but it should actually be there. Okay.
Okay, I'll look more closely, and maybe at the next session I'll have another question on that, because I do have my detailed statement of financial operations here, and I'm just not.
The thing you could do is forward through Lynn a picture of it or a copy of it, and she can get it to me, and I can, have a quick look and see what I can find.
Okay. I'll take another look, and I can get a hold of Lynn if I want to do that. Thank you.
Hours on it, obviously, but
no, I know, but I just appreciate it. I'm just trying to learn as much as I can to be, in front, so that I'm competent in front of the board type of thing.
Yeah. Been there, done that. You don't want your board asking questions you can't answer.
No.
Well, I don't know if we see any more questions. If not, I think that I would just like to take the opportunity to really thank you, Dave, and also thank you to my good friend Bruce Anderson at the Hill School of Business, who I always turn to for advice whenever I have the need for somebody in the community to help out with topics that are of interest to our community partners. So thank you, Dave, for doing such a fabulous job. And we will see you again on Tuesday, April 13th, where we'll have part 2 of this session, which will be on budgets and budget development. I will be sending Dave's slides to everybody probably later this afternoon or tomorrow morning, depending on how my day goes the rest of the day, along with the Zoom recording, so that if some of you found this to be such a brief overview, you will have that opportunity to look at that recording again. So thanks again, and I hope everybody has a great rest of your day.
All right.